Hello, good afternoon to all our regional directors, staff members and viewers across the country. We welcome you to today's teleconferencing program. This afternoon we have two sessions. Uh, the first session will be up to 1:45 and our second session will be from 2:30 to 3:15. Both these sessions are related to topics on the course Management of Financial Services. In this particular session, we'll be dealing about in general, the financial services and then a particular financial service, that is the venture capital. As we all know that financial services are services that ensure the smooth flow of financial activities in an economy. Financial services are a very important component of the financial system as they cater to the needs of the financial institutions, financial markets, and the financial instruments which are geared to serve individuals and institutional investors. Financial institutions and financial markets facilitate the functioning of the financial system through the financial instruments. To facilitate these tasks or to fulfill these tasks, there are a number of financial services which are required, and hence these financial services form the fourth element of the financial system. The functioning of the financial system depends upon the range of the financial services that are extended by the providers and their efficiency and effectiveness. So, dealing with these financial services are offered by the asset management companies as well as the liability management companies. So there will be different financial services obtained by which we will be discussing in this particular session, and then we will be discussing about the venture capital. And to discuss with us on this financial service, we have with us a very eminent person from the School of Management, Professor Ravi Shankar. So we welcome you to this session.
Well, thank you, Anjali.
Okay, so you can take over the session.
That's all. Okay. So, good afternoon. And as my colleague Anjali was telling you, the financial services is a very important component of the financial system. So this is these organizations are the facilitators of the funds from the surplus units to the deficit units or needy units. So this without these financial services, the financial system cannot work. Instruments are there and markets are there, and so financial services are very important in that sense. So today we will be talking to you on two different service providers. One is on the venture capital, and maybe in the second session we will be talking to you on the insurance in general. So in this particular session, I will try to tell you something about the venture capital. So the background, if we see, the general financial services are broadly categorized into two categories. That is, one is fund based and the other one is fee based. So because there are certain services which are required, which require funds. So those institutions, financial service providers, they are required to keep the funds, and they need to help the customer or whoever is in need of those services with the help of by providing the funds. So we call these these type of organizations fund-based services or fund-based service providers. and there is another category which is called fee-based services. These organizations or these providers of these services are they don't need to maintain any funds with them, and they extend a service, and for that extending that service they charge a fee. So we call them and classify them as fee-based services. So what are the fund-based services? We will see again. One is leasing and hire purchasing, because leasing and hire purchasing is very important when you want to create assets. Either you have to lease or hire purchase, or if you have the money you can buy on your own also. If you don't have sufficient money, you go for leasing or hire purchasing. So there the provider is required to keep the funds, and they help us in getting those assets on the lease basis or on the hire purchase basis. Similarly, housing finance. This is more in the personal finance area, but nevertheless it is a fund-based service, because for giving you a loan for housing, they need to have a fund. Then only they can extend those loan facilities to the users. Similarly, credit cards. Again, this is also a personal finance function related fund-based service, wherein whenever you need this thing money, you spend it through credit card, and you are postponing your payment to a later date. So this is also a fund-based service. For that means the person who is giving you the goods or services, they will be paid by the bank, and subsequently we are paying the bank by way of settling the credit card dues. So there also bank need to have funds. Similarly, again venture capital. Venture capital we will be discussing in detail in this session. So venture capital also is a fund provider. Venture capital undertakings, they provide funds to the venture capitalists, and so there need to be funds with them. So that is a fund-based service. Again, factoring and forfeiting and bill discounting. All these three services also require, because they may receive the payments at a later date, but they discount or factor the receivables and give the money to the organization immediately. So without waiting for the collections and all those things, they discount these services, bills or receivables, and get the money, and for that the provider needs to have funds, so that he can give the payments immediately and get them collected at a later stage. So broadly, these are the activities or the services we can classify under fund-based services. Then there is a category called fee-based services, where issue management. When the companies go for public issues, there is a host of whole lot of activities involved, and issue managers are the persons who are the people or the organizations who are involved in managing those things. So there are registrars, there are undertakers, several types of people are there. So there they provide the service for a particular fees. So we call it as a fee-based service. Similarly, corporate advisory services, then credit rating. Credit rating also is fee-based service. Similarly, mutual funds. Mutual funds, why we say mutual fund is also a fee-based service? They collect the money from us and they use it, invest it, and for a fee, and whatever is generated from that particular capital raised, they will distribute it to the investors, and they charge a fee, a portion of the fee. So it is a fee-based service. Then asset securitization. So broadly, the different services, financial services, are categorized under the two heads. One is fee-based service and the other one is fund-based service. So with this background, Now we will come to the actual topic, that is venture capital. First, why venture capital? Because venture capital is very much required, because everybody may not be having immediately, they don't there may be a very good idea with a technocrat or entrepreneur, but he may not have the sufficient required funds to invest and make that idea into a venture. So what happens is, there you need some support of the some support and some help from the external agencies or fund providers for setting up a venture. So the because he is not a established entrepreneur, so he may not be in a position to go to the market and raise the funds. So, or even the banks and other financial institutions, they may not be interested in giving to a very inexperienced entrepreneur. So there is a serious problem in materializing his ideas into a venture. So the requirement of venture capital is very essential, because there is a very bright idea, and unless we translate into action and a venture, it is not going to give you a worthwhile return. So the importance is very much there. Then one important thing about this venture capital is, financing ventures is that kind of ventures. Where the role of venture capital is important is, the ideas are very new and innovative ideas, but since they are not tried and tested, so they are very risky. They are risky, but at the same time, if they succeed, it will be a very good return or very high returns. So two things are there. Both the risk is high and also return is high. So unless we encourage this kind of new ideas, the growth will not happen in the economy also. So it was felt venture capitals are very essential, and because regular financing or even individuals or organizations may not be interested in providing venture capital to unknown person. So there is a need for venture capital. Then let us try to see what is venture capital. Venture capital can be broadly defined as long-term investment in business which has potential for significant growth and financial returns. So whatever I was talking in the previous slide, growth is there, risk is there. So because the investment is for a long period, so naturally there is a risk also, lot of risk also is there. And secondly, the idea is not so far tested, so risk also is involved, more risk also is involved. So long-term investment and untried idea. So both these two things put together make the risk little more than the normal risk. Second thing is, you have the attractive thing in the whole thing is the potential for significant growth and financial returns is very much there, because no other person has tried. So there is a lot of scope, if venture succeeds, that you will get a good return and also good financial returns, and also growth prospects are there. So what will happen, in what forms we can provide the venture capital? What happens is, sometimes primarily it will be in the form of equity, and there is also a way of financing through loans also. There may be conventional loans or conditional loans. Those two things we will discuss slightly later. So venture capitalist is, because why we are saying this is, equity is the primary source, because the venture capitalist is not a financer, or but he also bears risk. This is a very important statement. Venture capitalist is not a financer, but also bears risks, because role of venture capitalists or venture capital undertakings is very specific. they are they are supposed to support the organizations when they need money, and once the organization settle, they are supposed to get out of the organization. So because the organization is well settled, so there is no major role for the venture capitalist to play there. So they have to exit from that organization and maybe try with a different organization. That also we will discuss these things in detail slightly later. So he is not a financer. Why I am saying is, he is not going there for primarily for returns. It is not primarily for returns, because he will undertake the risk in the form of equity, because he is participating in the form of equity, so he is undertaking the risk. But at the same time, he doesn't want to participate and disturb the venture capital entrepreneur, whoever is starting the venture capital, he doesn't want to disturb him by interfering day to day. But wherever technical support and other support is required, venture capitalists definitely provide and see that the idea succeeds and becomes a profitable venture. So therefore, the role is very specific. He is not a financer. He is not there for just making money. He is there to support. He is there to support the entrepreneur, new entrepreneur, with all kinds of support and see that the venture capital succeeds. So venture cap. Then let us try to understand what is venture capital fund and what is venture capital undertaking. A venture capital fund has been defined as to mean a fund established in the form of a trust or a company, including a body corporate or registered with SEBI, which has a dedicated pool of capital raised in the specified manner. Because these two things are very important. There are two conditions. It is a venture capital fund is a organization registered as a company, trust or a corporate body with the SEBI. That is one thing. Second thing is, they should have a dedicated pool of capital raised in the specified manner, and second condition is, investments in venture capital undertaking is in accordance with these regulations. Because why I am saying is, the money you have to raise the money in the venture capital fund in a specified manner and invest them in the venture capital only. So what I am trying to say is, the money raised cannot be used for any other purposes than the venture capital and financing. A venture capital fund may be set up either as this thing. The purpose of raising funds should be to invest in venture capital undertakings in the specified manner. So the venture capital fund, whatever money is raised by the venture capital fund, should be invested in the venture capital undertakings only. So what is venture capital undertaking? A venture capital undertaking means a domestic company whose shares are not listed on a recognized stock exchange in India and who is engaged in the business of providing services, production or manufacturer of articles or things. It is like any company, but only difference here is, it is a undertaking trying to test a new idea by using the venture capital fund. So since it is a new company, there is no scope for the company to get it registered under the stock exchange. So this is the one of the conditions to get venture capital fund from the venture capital from the venture capital fund. Second is, the undertaking should be providing services or production or manufacture of articles or things, and does not include any such activities or sectors which have been included in the negative list by the board. What is the negative list? The negative list of activities includes real estate, non-banking financial services, gold financing, activities not permitted under Government of India's industrial policy, and other activities specified by the board. So, what in essence what it means is, the money borrowed from the venture capital fund should be used for creating for producing or manufacturing services or goods, but they should not be used as an investment in the form of investment by putting it in the real estate or gold or any other kind of services. So, the purpose is very clear and very specific, because you are creating the fund for a specific purpose and to encourage the new generation and new ideas. So, if you allow the things to diversify in a manner which is not going to help the venture capital undertakings, it is not going to serve the purpose. So, therefore, it is the focus is very specific. You have to raise the money for a specific purpose, and you have to invest the money only for that purpose. Next. So, the registration, then coming to the registration part of the venture capital funds. I think the distinction between venture capital fund and venture capital undertaking is very important. To put it in a very crude way, venture capital fund is the financer, and venture capital undertaking is the borrower. So, venture capital fund gives money for the purpose of helping the venture capitalist, and venture capitalist is an organization. Venture capital undertaking is an organization who is going to produce goods or provide services with the help of the money taken from the venture capital fund. So, once this distinction is clear, I think we will not be confused further. So, how a venture capital fund is registered? Venture capital fund is, as I told you earlier, it is it may be in the form of a company or a trust. So, it can be either in the form of a company or a trust, and say it has to be registered with SEBI, and on a specific application by the venture capital fund, the SEBI registers that particular organization as a venture capital fund, and they are supposed to be operating in that particular fashion. There are a lot of regulations to be followed before getting a registration. Those things we can study it from the material or even from the website. Venture capital shall not carry out any other business. As I told you earlier, venture capital fund should carry out only venture capital business of either providing services or producing goods. This is the manner, and they should not be using those funds for the investment purposes. So, where from the second issue, next issue after registration is where from you are going to get resources. As a venture capital fund, after all, the venture capital fund also should get some money from some sources. Then only they can pass on those funds to the entrepreneurs. So, because these are only facilitators. This venture capital fund is a facilitator of playing a facilitator role in the financial system, because they have to collect the funds from somewhere and they have to put the funds in somewhere. So, it is not that they should have their own funds and 100% their own funds and they will be investing in different venture capital undertakings. It is not that. Even banks or any financial institution for that matter, they raise the money from the public and invest and give it back to wherever there is a need, and they facilitate the process. So, similarly, venture capital fund is also a facilitating organization. They raise funds from different sources and give the money to the venture capital undertakings. So, what are the sources where from the venture capital fund can get resources? Venture capital fund may raise resources either from Indians or foreigners or NRIs by issuing units. Units means it is unit. When we say unit, it is a collection or group of shares in the no, it is not a share actually. When we say it is a share, when we say it is a unit, it is a unit in the sense in blocks of money. Blocks of money, and a unit cannot be less than rupees 5 lakhs. Rupees 5 lakhs. So a venture capital fund cannot accept a contribution. It is not contribution actually. It is cannot accept a deposit, we can say broadly, which is less than 5 lakhs. So the financer, the investor in the venture capital fund should at least invest at least 5 lakhs of rupees in the fund, and venture capital shall not issue any document or advertisement inviting subscriptions, because this is not a public issue. What we are trying to see here is, since it is not a public issue, they cannot issue a offer document or put advertisements in the newspaper asking for subscription. That is not done, and it is not allowed to do that way. And once the venture capital fund is established, units cannot be listed on a stock exchange till 3 years from the date of issue. So if you have invested in a venture capital fund and you have got units of the venture capital fund, you cannot sell them in the stock exchange till 2 years. Okay, you can sell otherwise, that is a different story, but stock exchange, you cannot register these units in the stock exchange for at least 3 years from the date of issuing of that units. Then what are the characteristics of a venture capitalist? I think most of these things we have covered, so I will quickly discuss these things. Provides risk capital largely in the form of equity. This is maybe for a recapitulating purpose we can do this. Provides risk capital because the idea is not tried, so definitely there is a risk element and slightly higher level of risk is there. So the venture capital fund participate in the form of equity, which means they are willing to take the risk also. By participating in the risk means the organization is willing to participate in the risk, because equity is definitely more equity instruments are more risky than the debt instruments. So when we are participating in equity means we are ready to take the risk. Does not act as a owner. I told you earlier, does not act to participate as a owner because they want to allow full freedom to the entrepreneur, because it is his idea. Let him try on his own way, and wherever there is a need, we will definitely come and help them. But though they are equity investors, they don't meddle with the day-to-day matters in the organization. And third thing is, once the venture becomes profitable, they withdraw from the venture capital undertaking, because once the venture is successful, their role, I think, comes to an end, and they try to invest the money in some other venture capital undertaking rather than just staying in that particular thing. Because once the idea comes once the idea is created and converted into a successful organization, the role of venture capital funds becomes very minimal, because if they continue there, it is a regular business. That means they are not doing the venture capital. So what they do is, after the organization becomes successful, they exit from the organization. intends to earn largely by capital gains rather than through regular incomes in the form of interest. This is also important because
Sir, I
since,
have a small doubt.
yeah,
So
I
venture
think let me
capital.
complete this and we will take
Okay.
up that. So, uh, they are interested, the venture capital intends to earn largely by way of capital gains because they are more interested in the growth of the organization so that the shares of the organization becomes very profitable and the price of the share goes up, then there is a benefit in the form of capital gains rather than giving it as a debt instrument and as in the form of debt and trying to get some interest periodically, because the venture capital and venture capital funds invest in the form of equities. They are more interested in the long term survival of the company rather than immediate recovery of their loans. Then they provide conditional loans that I will cover slightly later. Yeah, Anjali, we can take up whatever.
So venture capitalist is a person who's providing venture capital.
Mm.
And then venture capital fund.
Venture capital fund is the, actually it is synonymous. Venture capitalist
Okay.
may be an individual.
Mm.
Venture capital fund is an organization.
Okay.
Okay?
Thank you.
Yeah, then stages of venture capital finance, because there are different stages in the in making a venture or a idea into a venture. So there are different stages of the in the process. So at every stage there is a need for finance. So we have classified or broken down those phases into different stages. Broadly, what we can say is the financing pattern. When we analyze, we can broadly categorize them into early stage financing and the later stage financing, because early stage means at the beginning of the at the first time when you are converting the idea into a venture, that is the for early stage financing. And once the venture is there for some time, and after some time they may get another idea further for the further growth or development of the organization, and there also they may require some financing. So that is called venture capital financing, and there are different things. We will discuss each one of them specifically. First one is seed capital stage, because broadly there are three categories. One is seed capital stage, second is startup stage, third second round financing. So these three, in the process of converting an idea into a venture, these three types of stages are involved, and definitely at each stage the venture capital fund provides financing. Seed capital stage means you have an idea, but you have to try and experiment and concretize the idea and make it into a viable business proposal. So there maybe some laboratory work is involved or further research is required. Particularly these things, venture capital's role is very important in research-oriented organizations. For example, what is that? Biotechnology or biopharma, this kind of areas. So there, the idea making an idea into a venture is a very lengthy and time and money consuming process. So that idea has to be tried, experimented, and whether that idea is successful, these things are required. And up to making it a business proposal, we can say seed capital stage, we can call it as a seed capital stage. So there finance is required, and definitely venture capital funds do finance such requirements also. Then second stage is startup stage, where idea is there, it starts from the idea, from the successful proposal, and from there you start working and make it a commercially viable undertaking. So that period we can call as startup stage. And second round of financing means once the establishment is there, undertaking is settled, facilities are created, and now you have to start the production. So there you need working capital finance and other types of finances. So there also the third stage also comes, and venture capital funds provide finance there also. Coming to the later stage financing, as I told you, expansion is one option where you require financing. Suppose the idea needs further extension, further expansion. So definitely, since it is continuation of the same idea, definitely organizations need more finance there, and venture capital funds participate there also. Replacement financing. Replacement financing means if a group of shareholders in a venture capital undertaking wants to move from the venture capital undertaking because they may not be very seriously interested in continuing. So there the entrepreneur faces a problem. Suddenly if somebody wants to sell their shares and get away from there, and maybe the promoter may not be having sufficient money to buy those shares and continue the business. So there he can seek the help of venture capital funds, and with that money they can purchase the shareholders, the shares of that particular group of shareholders who wants to go. So we call it as a replacement finance. That is one finance where venture capital fund also participate. Then there is a third category called turnaround financing, because there may be a situation where a venture capital, an entrepreneur who has taken the help of venture capital funds and tried to create an organization, but somehow it has failed in the process. So there may be another entrepreneur with better ideas who may want to continue the organization, continue in the organization and turn it around. So for turning around of the old organization also you require some financing, and venture capital funds participate in that kind of financing also. Then there are buyout deals also, buyout deals financing. What we say is there may be some group of shareholders who are not very active, but they are there, and there may be some promoters who are very active. In such a situation, probably the active promoters or active shareholders may want to buy the shares or the of the promoters who are not actively participating, so that they can use the they can really put these ideas into proper use. So there venture capital finance funds, venture capital funds also, there also they will help. So at whatever we can visualize the stages, at every stage the venture capital funds are financing the entrepreneurs and creating venture organizations like this. So next, what are the different forms of providing finance? So equity is one, broadly as we were discussing and everybody knows, there are two ways of financing. One is equity and other is debt. So equity, within equity, ordinary shares and preference shares. Everybody knows what is an ordinary share and what is a preference share. So when you want to take more risk, you go for ordinary shares, and when you want to take little less risk, then you take preference shares, because preference shares get preference in their claims when compared to ordinary shares or equity shares. So if venture capitals, mostly they go for ordinary shares, and also they participate in the different debt instruments also. And the conditional loans, some of the conditional loans, why I think earlier also I referred, this is a very important thing, because conditional loans is normally when we give debt, there is a specific period and for settlement of this thing, and there is a specific rate of interest at which the money has to be for the borrowed money is a rate which is charged to the borrowed money, which is called rate of interest. So in this kind of conditional loans, there may not be any such specification about the rate of interest and the period after which it has to be returned, because this is very genuine also, because this venture is a very new and experimenting type of venture. So there are lot of uncertainties. So once we start putting unfavorable conditions, the organizations may not be able to function freely and be bogged about with more financial problems rather than the other issues. So I think appreciating the need of this situation, the venture capital funds devised such loans that there may be a situation that there is no rate of interest and there is no time specified for returning the loan also. What will happen in such a situation? What they do is they take a percentage of the sales proceeds and they take it as a repayments. So these kind of conditions can prevail. These kind of conditional loans also are provided, looking into the situation and the situation of the organization where it exists. Then there are convertible loans. Convertible loans means they are provided as a loans, but to be converted into equity once the after a certain specific period. Then the regular term loans. So these are the various modes of financing the venture capital organizations. Then important thing, as I told you, after a particular period, these organizations exit from the venture capital undertakings. Venture capital funds exit from the venture capital organizations. What are these? How there are different routes of exiting also. First one is initial public offerings. Once the organization, venture capital organization, venture capital undertaking becomes profitable, the venture capital funds may go to stock exchange and offer their shares in the form of IPOs, and they can sell them at a profit and they can exit like that. Or there is another way of exiting also. There are different ways. Second way is buyback of shares by promoters. First, actually, this is the first tried. Normally, venture capital funds try this option first, and if that is not workable, then they go for the other options. Buyback means whatever shares are there with the venture capital fund, they try to offer those shares to the promoters at the market price. If the promoters are willing to buy, they will sell. They will get the first claim and they sell it to the promoters and take their money back. Otherwise, they have the other options to go. Then there is a third option of exit also, that is sale of enterprise to another another company. So this enterprise is shown to is sold to another company, and like that sale to new venture capitalist, liquidating process. These are the normal ways of I think we can since time is running out, we can appreciate these headings, because the whole idea is the company, the venture capital fund is exiting from the venture capital undertaking, and there are different routes for it.
I think we'll have to stop it here.
We'll have to stop.
Yeah.
Okay.
We hope that you all must have means your ideas about venture capital and the various aspects of it must have been very clear by now. We thank, on behalf of you all, I would like to thank Professor Ravi Shankar for giving such a good presentation.
Thank you.
Thank you.